At 6:17 on a Friday evening, you are sitting in a chair that is designed to make you feel comfortable for exactly long enough to sign something expensive. The office is too cold. The walls are covered with framed awards. There is a glass bowl of candy between you and the desk, and somewhere outside, a salesperson is walking around the car you came to buy, polishing a surface that was already clean. The finance manager smiles at you. "Good news," he says. "I got your payment down to $636 a month." You look at the number, 636. It sounds manageable. It is less than 700. It is less than your rent. It is close enough to the number you told yourself you could handle when you searched for the car online. Then the manager slides a tablet toward you. Just initial here, here, and here. This is the protection package. This one is the extended service contract. And this is gap coverage. Most of our customers take all three. You ask one question, what is the total amount financed? The smile pauses, not disappears. Because the monthly payment is the number you were invited to care about. The amount financed is the number that controls your next 6 years. And that is the difference between shopping for a car and shopping for a loan with 4 wheels attached to it. The title of this video says, Dealership finance managers hate when you know these 7 numbers. They do not literally hate you for knowing them. Good finance manager can work with an informed buyer. What they dislike is losing control of the order in which the numbers enter the conversation. If you focus on the monthly payment first, every other number can be adjusted around it. The price, the interest rate, the loan term, the trade-in, and the add-ons. But if you know the 7 numbers, the conversation changes. You stop asking, "Can I afford this payment?" Start asking, "What exactly am I paying for? How much am I borrowing? And what will this decision cost me when the excitement is gone?" So let's walk into that office together. Not as an angry customer. Not as someone trying to win a fight. As someone who knows the math. Number 0. The monthly payment is a distraction before the 7 numbers. There is one number you need to demote. The monthly payment. It is not useless. Your budget is monthly. Your income is monthly. Your bills are monthly. Of course, the payment matters, but the payment is an output, not a price. It is created by 3 moving parts. How much you borrow, the interest rate, and the number of months you agree to keep paying. If someone lowers the payment without lowering the amount borrowed, they may simply be stretching the loan longer. A payment can fall while the total cost rises. That is why the first question in the office should not be, "Can you get me under 600?" Should be, "What is the out-the-door price? And what will the final contract say?" Payment comes later, because a low payment can be a soft blanket covering a very hard number. Number 1, the out-the-door price. The first number is the out-the-door price, not the price on the windshield. Not the number in the online listing. Not the price before taxes, registration, documentation fees, dealer fees, accessories, or anything else that appears after you have already imagined the car in your driveway. The out-the-door price is the amount required to purchase the vehicle before your trade. Down payment and financing choices are applied. It can include the negotiated vehicle price, required taxes, registration, and dealer or documentation charges. The exact items vary by state and country, which is why you ask for an itemized buyer's order instead of relying on a verbal total. Here is the scene. The car is advertised at $29,000. You feel like you are buying a $29,000 car? But the worksheet says $29,000 for the vehicle, $1,000 in dealer and documentation charges, $2,400 in tax and registration. Your real out-the-door price is $32,400. That does not mean the dealer is automatically doing something wrong. Taxes and required charges exist. Some fees are negotiable, some are not, and the rules differ by location. The point is simpler. You cannot compare to vehicles by their advertised prices if their out-the-door totals are different. A $30,000 car with low fees can be cheaper than a $20,000-$1,000 car with expensive mandatory additions. Ask for this number in writing before discussing the monthly payment. Say, "I am comparing total out-the-door price, not payment. Please itemize every charge." That sentence moves the conversation from emotion to arithmetic, and it protects you from the most expensive sentence in the showroom. Don't worry about that part. We'll work it into the payment. Number 2, your real trade-in equity. The second number is not your trade-in value. It is your trade-in equity. Those are different numbers. And confusing them can make a buyer feel like they received a discount when they actually carried old debt into a new loan. Imagine your current car receives a trade allowance of $10,000. That sounds like a $10,000 credit. But your existing loan payoff is $12,500. The car is worth $10,000 to the dealer, but you owe $12,500 to the lender. Your equity is negative $2,500. That negative equity does not disappear because you change cars. It goes somewhere. It can be paid in cash. It can be reduced by negotiating a better trade value. Or it can be rolled into the next loan, where it becomes part of the amount you owe on the replacement vehicle. This is where the old payment can become a trap. You tell yourself, my current payment is $480. If the new payment is only $636, that is not too bad. But the new loan may contain the unpaid balance from the old car, plus the new vehicle, plus taxes, plus fees, plus products you did not originally plan to buy. The old car is gone. The old debt is not. Ask for two separate numbers. What is the exact lender payoff? And what trade value are you giving me? Then subtract one from the other. Positive equity is money you can use toward the next purchase. Negative equity is a balance you are carrying forward. Neither one is a moral judgment. People end up upside down for many reasons. Depreciation, long loans, unexpected life events, or simply buying more vehicle than their previous equity could support. But the number must be visible, because a trade allowance is not the same thing as wealth. Equity is what remains after the lender gets paid. The third number is the number that turns the showroom conversation into a long-term obligation. Number 3, the amount financed. This is the amount the lender is actually advancing for the transaction after the down payment and trade credit are applied, but including the amounts that are rolled into the contract. In our example, the out-the-door price is $32,400. You have $2,500 of negative equity from the trade. You put $2,000 down. Then the finance office adds $2,400 in optional products. $32,400 plus $2,500 minus $2,000 plus $2,400. Your amount financed is $35,300. You thought you were buying a $29,000 car. You are now borrowing $35,300. That difference is not automatically proof of a bad transaction. Some products may be valuable to you. Some buyers deliberately roll negative equity into a new loan because they need reliable transportation and do not have the cash to resolve the old loan first. But if you do not know the amount financed, you do not know what you are buying. You only know the size of the monthly slice. Look for the amount financed on the retail installment contract. Depending on the form, it may appear next to the itemized price, down payment, trade credit, and financed products. Ask, please show me exactly how you reach this amount. If the number is higher than expected, do not let the room rush you into signing while you are still reconstructing the math. A $2,400 add-on does not stay a $2,400. It's a decision when it is financed for 6 years, at an 8.99% APR over 72 months. That package can add roughly $43 to the monthly payment and more than $3,000 to total payments. The product may still be worth it to you, but now you are deciding based on its total cost, not its appearance as a small line inside a large loan. Number 4. The APR. The fourth number is the APR, not the interest rate mentioned casually across the desk. The annual percentage rate shown in the contract. The APR reflects the yearly cost of credit and may include certain finance charges. It is the number you use to compare one financing offer with another, although you still need to review the complete contract. The deal-arranged rate can be different from the rate offered directly by your bank or credit union. That difference may depend on your credit profile, the lender, the vehicle, the loan term, current market conditions, and rules governing deal-arranged financing. You do not need to accuse anyone of hiding anything. Simply need a benchmark. Before you visit the dealership, request a pre-approval or rate quote from a lender you trust. Ask for the rate, term, amount, and any conditions attached to it. Then compare the dealer's APR to that offer. Here's what a small rate difference can do. On $35,300 over 72 months, an 8.99% APR produces a payment of roughly $636, with total payments of about $45,800. At 7.49%, the payment is roughly $610, and total payments are about $43,900. Okay, the difference is around $26 a month. That sounds small. Over the life of the loan, it is close to $1,900. This is why the APR belongs in the spotlight. The lower payment might be the result of a longer term. The lower price might be offset by a higher rate. The special financing might only apply to certain credit tiers or shorter terms. You are not looking for one magical number that makes the deal good. You are looking for the relationship between the numbers. Amount financed, APR. Term, total of payments. The contract is a machine. Change one input, and the output changes. Number 5. The loan term, the fifth number, is the loan term. How many months will your money be committed to this vehicle? 8. 60, 72. 84. The longer term is attractive because the required payment falls. But the car does not become cheaper. You are simply spreading the cost across more months, often paying interest for longer and increasing the risk that you owe more than the vehicle is worth. Return to the same $35,300 loan at 8.99%. At 60 months, the payment is roughly $733. Total payments are about $43,956. At 72 months, the payment falls to about $636. Total payments rise to approximately $45,800. You save about $96 every month. You pay roughly $1,845 more over the life of the loan. Neither term is automatically right or wrong. Shorter loan can create a payment that strains your budget. A longer loan can be reasonable if the rate is favorable and the vehicle is reliable. The danger is choosing a term only because it creates a payment that feels comfortable in a room where you are already emotionally committed. Ask one more question. How long do I expect to keep this vehicle? If the answer is 3 years, a 72-month loan deserves more scrutiny. You may be selling or trading the car while the loan balance is still high. If the answer is 10 years, reliability and total cost may matter more than resale value. A loan term is not just a payment setting. It is a time commitment. It determines how long the lender remains in the background of your life, collecting a piece of every paycheck before that money becomes yours. Number 6. The total of payments, the sixth number, is the total of payments. This is the number that answers the question the monthly payment avoids. How much will I send away before this debt is finished? In the contract, you may see the amount financed, the finance charge, and the total of payments. The total of payments is the combined amount of all scheduled payments over the full term, assuming the contract remains on schedule. It is not necessarily the total cost of ownership. Fuel, insurance, maintenance, repairs, and depreciation are separate, but it tells you what the loan itself will consume. In our example, the $35,300 amount financed becomes approximately $45,800 of scheduled payments over 72 months. That extra $10,500 is the cost of borrowing under that example. Now imagine the conversation had stayed focused on $636. $636 feels like a monthly lifestyle choice. $45,800 feels like a financial decision. That is why the total of payments is powerful. It converts the loan from a small recurring charge into a visible lifetime commitment. If the finance office offers to lower the payment by extending the term, ask them to show both total payment numbers side by side. If an add-on is only $20 a month, ask what that becomes across the entire contract. $20 multiplied by 72 months is $1,440 before considering any interest effect. The question is never, is $20 a lot? The question is this product worth what it costs over the full time I am financing it? This number is not designed to scare you. It is designed to give the decision its full size. Number 7. The seventh number is the combined cost of every add-on and the price of each add-on by itself. Service contracts, gap coverage, maintenance plans, paint or fabric protection, wheel and tire coverage, theft deterrent products, key replacement, etching, nitrogen. Some products can be useful. GAP coverage, for example, may matter if you owe more than the vehicle is worth, especially when negative equity is involved. A service contract can make sense for a vehicle with expensive repairs and a buyer who values predictable costs. The point is not that every product is a scam. The point is that most customers choose this is not a reason for you to choose it. Ask for the price of each product, whether it is optional, what it covers, what it excludes, whether there is a deductible, and how cancellation works under your contract and local rules. Then ask the question that makes the hidden cost visible. What will this add-on cost if I finance it for the full term? A $2,400 package can become more than $3,000 in scheduled payments at the example rate and term. If you cancel an eligible product later, the refund may be calculated according to the contract. It may reduce the loan balance rather than put cash directly in your pocket. The rules vary, so read the paperwork instead of assuming. You also want to know whether the add-on duplicates coverage you already have through your insurer. Manufacturer warranty, credit card, roadside plan, or another policy. You are allowed to say, I need the contract price without the optional products first, and I will decide which, if any, I want to add. That sentence separates the car from the menu. We're not rejecting protection. You're refusing to buy protection before you know its price. Now return to the office. The finance manager has told you the payment is $636, but you ask for the 7 numbers. The out-the-door price, $32,400. The trade payoff, $12,500. The trade allowance, $10,000. Your equity, -$2,500. The amount financed, $35,300. The APR, 8.99%. The term, 72 months, approximately $45,800. The add-ons, $2,400 before financing cost. The payment is still $636, but it no longer looks innocent. It has a history now. It contains old debt, new debt, interest, fees, optional products, time. The room does not become hostile. It becomes clearer. The manager removes one product, you keep another. You compare the APR to your pre-approval. You ask for the buyer's order and the retail installment contract. You take your time. Maybe you buy the car, maybe you leave. Either decision can be a good decision if it is made with the complete numbers in front of you. That is the part people miss. The goal is not to defeat the dealership. The goal is to avoid defeating yourself with a payment you never fully priced. For signing, read these numbers one final time. 1. Out-the-door price. Do trade allowance, lender payoff, and your actual equity. 3. Amount financed. 4. APR. 5. Loan term in months. 6. Total of payments. 7. Every add-on, its price, its coverage, and its cancellation terms. If any number changes from the worksheet to the final contract, stop and ask why. If the answer is unclear, do not sign while confused. A car can be replaced. A rate can be compared. Purchase can be delayed. But once you sign, the excitement becomes a contract, and the contract does not care how good the test drive felt. The strongest buyer in the finance office is not the loudest buyer. It is the buyer who can sit quietly while the numbers are explained. 3 months later, you are driving the car home from work. The dashboard is clean. The seats still smell new. The payment has already disappeared from your bank account once, and the excitement is beginning to settle into routine. But you know what the car cost? Not just the number on the window, not just the number on the monthly reminder. You know the price outside the door. You know what happened to the trade. You know what you borrowed. You know the rate, the months, the total, and the products attached to the loan. That knowledge does not make you suspicious of every dealership. It makes you responsible for your own side of the table. Because real financial confidence is not looking rich in the showroom. It is leaving the showroom with a decision that still makes sense when nobody is applauding. The salesperson is gone, and the only person who has to make the payment is you. Dealership finance managers do not hate informed buyers. They hate losing the advantage created by confusion. And confusion disappears the moment you ask for the numbers. This is Peak Ledger. Subscribe for more stories about the hidden math behind ordinary financial decisions. And next time someone asks, what monthly payment are you looking for? You can answer, first, show me the total price.